What's up, folks? I'm Charles Urianis,
I'm a boss Bowsy,
and today we'll be talking about one of the tools of monetary policy, reserve ratio.
and I'm going to explain it to you guys and give you just some characteristics, and then Charles is going to put it into practice so you guys can take a lot of knowledge out of this video and put that into practice for your own economic class and things such as that. So the required reserve ratio is a central bank regulation, or the Fed, who sets the number of minimum fractions of customer deposits and notes that each bank must hold as reserves. So that's basically the definition. I'm going to break that down for you guys with some characteristics. So the reserve ratio changes the money multiplier. And the money multiplier is basically this fraction of 1 over the required reserve ratio that Charles is going to explain later on. So lowering the reserve ratio increases the money supply, therefore increasing money supply. And in turn, increasing the reserve ratio decreases the money supply, therefore decreasing money supply. So basically what I just told you guys, Charles is going to explain so you guys can get a better grasp of what we just talked about.
So let's say I'm a bank, and I have $100 in total deposits from my customers. And the reserve ratio is 10%. Therefore, I have to keep $10 in reserves, and I can loan out $90. This affects money multiplier money multiplier is 1 over reserve ratio. If the reserve ratio is at 10%, I have to keep $10 in reserves, and therefore our one of those $10 that we're loaning out creates $10 more. Now see, if the reserve ratio is raised to 20%, I have to keep 20 in reserves, and I can only loan out $80. And in relation to the money multiplier, if the reserve ratio equals 20%, it's 1 over 0.2, which therefore the $80 I am loaning out only goes $5 as far. When it's 10%, each dollar goes 10 extra dollars. When it's 20%, each dollar only goes $5. Therefore, decreasing money supply in the economy. And usually they use reserve ratio when the economy is speeding up too quickly. They raise reserve ratio, so banks have to keep more in reserves and aren't able to lend as much. And then when the economy is going through a recession, they lower reserve ratio, so then therefore the banks can lend more and people can spend more money, small businesses can take out more loans, and money supply will then increase.
So we hope this video was really helpful and informative. This is the required reserve ratio. We tried our best, so we hope it helped.
Thank you guys.